They didn't just rattle the cage, they actively tried to steal your position. Over the last 24 hours, silver didn't just dip, it was slammed down on purpose. If you watched the tape yesterday, you saw the carnage hit fast, a nasty sell-off, a sudden smash, media claiming the squeeze is dead. Right then the fear worked on you. Pulse racing, conviction shook. You didn't question the metal, you questioned your own gut. That split-second doubt was the goal. Because today the charts revealed the real game. Silver ripped back to the mid-70s in one session, taking back nearly half of yesterday's smash. A broken market simply doesn't move like that. That is a bear trap snapping shut. Real crashes bleed out slowly. Fake dumps rip back hard. We didn't see fundamentals fail. We saw a forced liquidation raid designed to transfer cheap ounces from emotional hands to the strong hands. The mechanics are simple and vicious. High leverage invites these precision raids. Stop losses bunch up at key zones. The algos see this, the banks see this, so they push spot price just deep enough to spark a panic flush just long enough to fake a real breakdown. Once the paper selling is finally exhausted, the rip begins rapid, brutal, and coming with zero notice. Here's the hard pill to swallow. If you sold out yesterday, you didn't exit risk, you absorbed it for a whale. Markets need sellers to climb higher. They fabricate panic when sellers dry up. Once that fear works, they ditch it cold. That's why today feels shocking. Not because the bounce is odd, but because the story flipped way too fast for your emotions to actually keep up with it. If you're still stacking, get this straight. You weren't the mark. You survived the shakeout. Volatility is the ticket price here. The game doesn't pay for hope, it pays for guts. Yesterday wasn't the end. It was a total reset. And resets happen right before the blast-off, not after the tank is empty now. This is where grasping the game matters more than crystal balls. Because if you keep your head while they weaponize fear, you don't just survive, you position yourself ahead of exactly what comes next. If this breakdown helped you stay focused, support the stack. Type 1 in the comments if you held through the smash 2. If you bought the dip, and subscribe, because the next phase of this move will be faster, louder, and far less forgiving to shorts. To understand why the rebound was so violent, you have to see who panicked and who didn't. When silver dropped hard, the selling didn't come from long-term stackers. It came from speculators, the tourists, traders who borrowed confidence instead of building it. They trade with margin-tight stops and fragile minds. When price moves against them, they don't reassess, they react, and reaction is pure liquidity. That liquidity is exactly what institutions hunt for. Big buyers cannot enter quietly when price is rising. They need sellers, and when sellers disappear near highs, the market creates them. That's why the drop felt unnatural. It wasn't driven by new info. Mines didn't shut down. Industrial demand didn't vanish. Nothing fundamental changed at all. What changed was the pressure. The market just shook the tree hard. As price fell through key levels, stops were triggered in waves. Each wave fed the next one. Fear accelerated selling, and selling validated fear. This feedback loop is powerful, but it is temporary. Because once weak hands are gone, selling dries up. And when selling dries up, price doesn't drift higher, it snaps back hard. That snap is exactly what you saw today. The bullion banks didn't chase silver at 80. They waited. They let emotion do the work. Once contracts were dumped in panic, they stepped in aggressively, absorbing supply without hesitation. That's why the recovery wasn't slow or cautious. It was decisive. When smart money commits, it doesn't test the water. It takes it all. This is why calling yesterday a crash is misleading. Crashes destroy structure. Yesterday didn't. Support didn't fail. It was briefly violated and immediately reclaimed. In market terms, that's not weakness, that's confirmation. It proves demand is waiting underneath price, not chasing above it. And this pattern matters because it repeats over and over again. Every major bull market punishes late leverage and rewards early conviction. The pain isn't accidental, it's functional. It clears the path for the next move by removing those who cannot survive it. If you're still here, you're no longer guessing what kind of market this is. You are living it, and experience is what separates participants from true professionals. Now we need to talk about the machines, because modern markets are no longer driven by human hesitation. They are driven by code. Commodity trading advisors, momentum, algos, trend-following systems. These are the dominant force in short-term price action, and once you understand how they operate, yesterday's chaos becomes quite disturbingly logical. These systems don't think, they react. They are programmed to sell when price breaks key levels and buy when momentum flips back in the other direction. Yesterday, when silver slipped below critical support, the machine switched from neutral to aggressive sell mode. Billions in futures were dumped automatically, not because the market was broken, but because the rules demanded it. This accelerated the fall, creating the illusion of a massive collapse. But algorithms have a major weakness. They cannot interpret context. They only recognize direction. So today, when price reclaimed, lost ground, and surged back above prior levels, those same systems were forced to reverse. Not gradually, instantly. They had to buy back everything they sold yesterday while simultaneously opening new long positions to follow the renewed momentum. This creates a double demand surge, short covering plus fresh longs, and the result is a vertical move that feels unreal if you are watching it all live. This is why V-shaped recoveries exist. Not because markets are kind, but because algorithms are trapped by their own logic. They chase price both ways, and when sentiment flips faster than positioning, can adjust the machines amplify the reversal just as violently as they amplified the crash itself. This is also why emotional traders consistently lose to systematic ones. The machines don't feel regret. They don't second-guess. They simply execute. And when they're wrong, they correct by buying more, not less. That's the irony. The same systems that punish late buyers reward early holders here. If you understand this, volatility stops feeling random. It becomes predictable in behavior, even if not in timing. Sharp drops followed by sharper reversals are not signs of instability. They are signatures of algorithmic dominance in a thin market now. And right now, thin markets are exactly what we are dealing with here. Which brings us to the next layer of this move, liquidity bonds and why silver doesn't move alone here. Silver never moves in isolation, and anyone trading it as a standalone asset is already blind to half the picture. To understand why silver was allowed to run today, you have to look at what happened beneath the surface in the bond market, in liquidity, and in gold. Yesterday's sell-off wasn't born in silver. It was transmitted right into it. The bond market seized up, yields spiked, collateral tightened, and liquidity vanished for a brief but violent window. When that happens, everything gets sold. Not because investors want out, but because they need cash. Gold was dragged down hard, not due to weakness, but due to forced liquidation. Silver, being the higher beta metal, took the hit even harder then. But here is the key. That kind of selling doesn't last long. Overnight, the pressure eased, repo markets stabilized, stress indicators cooled, whether through direct action or quiet coordination, liquidity returned. And when gold stabilized, silver was given permission to move. Gold is the anchor. Silver is the accelerator. When the anchor holds, the accelerator slams hard. That's exactly what we saw today. Gold stopped bleeding. Silver exploded. This relationship is not theoretical, it's structural. Silver leads on the way up because it reflects both monetary fear and industrial demand. It crashes harder on the way down because it's thinner and more leveraged. But when the dust settles, it moves faster in the direction of the trend now. This is why today's recovery matters so much. It confirms that the liquidity shock was temporary, a flash storm, not a climate change. The broader system did not break, and because it didn't, silver snapped back to where it belongs now. If gold had continued lower, this would be a different conversation, but it didn't. It held. And that hold is the signal that the monetary floor remains intact here. Understanding this correlation is your safety net. As long as gold remains supported, silver is not in danger, it is coiling. And coils don't resolve sideways forever now. They resolve very violently. Now let's talk about something. The paper charts can't hide the physical market. While futures were collapsing yesterday and screens were flashing red, something very different was happening behind the scenes. Physical silver didn't panic. It didn't get cheaper. In many cases, it got more expensive. Dealer premiums didn't fall during the crash. They rose. And that tells you everything you need to know now. If price were truly breaking, physical sellers would rush to unload inventory. They didn't. They pulled metal off the market. That means the paper price fell below the level required to convince real holders to sell. In other words, the futures market detached from reality briefly, and when that happens, it never lasts long. Industrial buyers understand this better than anyone. They don't care about 5-minute candles. They care about securing supply. Reports from the dip show aggressive buying in the low 70s, not from speculators, but from entities that actually consume silver. They stepped in early, absorbed selling pressure and created a massive concrete floor under the spot price. That is exactly how true market bottoms are established. Not with euphoria, but with quiet absorption. The paper shorts pushed down but couldn't sustain it. Sellers exhausted supply. Stackers didn't. When that divergence appeared, the rally became unavoidable. This physical floor makes yesterday's price action paramount. It confirms $74 isn't costly, it's mandatory. It is the fiat price needed to release physical bars. Below that supply is zero. Above demand persists. That is not fragile. That is a massive squeeze waiting to destroy the naked shorts. The technical damage from the flash crash looked bad, but it failed to stick. The breakdown reversed. Support was retaken. In market lingo, a failed crash is bullish. It proves the bears arrived and got slaughtered. The bull trend did not die, it just hardened completely. As we grind toward the final trading days of the year, this reality matters more than any headline. Funds care about where price settles, not where it fell. And right now, the structure signals something clear. The silver bulls are still in total control. This brings us to timing, because timing is where structure and payouts collide. We are nearing the final trading day of the year, and in Wall Street terms, this is not just another session. It is Judgment Day. Profits are measured at the close. Bonuses are decided at the close. Careers are defended at the close. And that cold reality changes all behavior. Funds that are long silver have one objective right now: finish the year strong. They want the chart to look perfect. They want the breakout to look undeniable. And they are willing to spend capital to make that happen. This practice is known as marking the close. And while it's perfectly legal, it is extremely powerful. Price is pushed not because of new information, but because incentives demand it. This is why today's rally is not random. It is the opening move of a year-end defense. After yesterday's flush, allowing silver to close weak would undermine the entire narrative. It would raise uncomfortable questions from clients. So the response is forceful. Futures are bought up. Weakness is defended. The tape is guided higher. What makes this moment rare is total alignment. Market structure wants a higher close. Fundamentals want a higher price to unlock supply. Momentum systems have flipped back to buy. These forces don't always agree, but when they do, moves accelerate fast. The short sellers understand this too. Anyone who pressed shorts into yesterday's breakdown is now trapped. Price reclaimed key levels too quickly. That speed matters. When a breakdown fails within 24 hours, it creates forced buying. Shorts must cover into strength, adding fuel to the fire. This turns dips into buying opportunities, not threats. But do not confuse strength with calm. Thin holiday liquidity means volatility remains elevated. Swings can still be sharp. The difference now is direction. The market has chosen it. The test wasn't about price, it was about pure resolve. And that test cleared the whole board. Now we shift from the immediate battle to the broader cycle, because what just happened didn't weaken the trend, it prepared it. One of the most overlooked truths in markets is that strong trends require resets. Momentum cannot rise indefinitely without releasing pressure. Yesterday's drop did exactly that. It cooled indicators, flushed leverage, and reset positioning without damaging the long-term bull structure. This is where the January effect enters the picture. Fresh capital doesn't chase overheated charts. It looks for strength that has been tested. With silver back in the mid-70s, the asset is no longer stretched, but it is still trending. That is the ideal entry zone for institutional money rotating in at the start of a new year. From a technical standpoint, conditions are now balanced. The market isn't overbought, it isn't broken, it's coiled. And coils are where trends are renewed. What looked like chaos was actually preparation pressure being released so the move can continue without tearing itself apart. Psychology confirms this. Fear peaked yesterday. Relief dominates today. But relief is deceptive. It tempts complacency. The market thrives on that transition, fear to relief to disbelief. Those who survive the fear are often shaken out by hesitation later. That is why understanding where we are in the emotional cycle matters. In true bull markets, dips are bought instinctively. That's exactly what we saw. The aggressive response to weakness wasn't accidental. It was learned behavior. Participants now expect higher prices and act accordingly. That shift doesn't happen in bear markets. It happens when a trend is healthy. The move toward 80 didn't fail. It paused. And pauses after resets tend to resolve in the direction of the larger force. With leverage reduced and demand intact, the path forward is clearer than it was before the drop. The market didn't break. It breathed out. Now we look beyond charts and into flow because supply chains don't care about sentiment. As the calendar turns, the physical system tightens. Refineries slow output during year-end audits. Inventories are counted, not expanded. At the same time, industrial buyers prepare for a new budget cycle. This creates a dangerous imbalance, restricted flow meeting rising demand. January isn't just psychological, it's structural. Corporations reopen capital expenditure budgets. Procurement departments move from conserving cash to securing materials. Silver isn't optional for them. It's an input. Solar, electronics, energy storage, none of it functions without silver. And when multiple buyers chase limited supply, price doesn't negotiate. It gaps up. This is why the floor established in the low 70s matters. It tells us that available supply is already spoken for. Any new demand has to bid above existing holders. That is how price discovery begins, not with speculation, but with necessity. Globally, the pressure is even clearer. In several currencies, silver never pulled back. It continued printing highs. That creates arbitrage demand. Metal flows toward the highest bidder, and right now the global bid is rising. You cannot suppress a global asset in one market when it's breaking out in others. This is also where volatility becomes a tax. As price rises, swings widen. Moves become faster and less forgiving. This isn't instability, it's scarcity asserting itself. Thin supply combined with urgent demand doesn't produce smooth trends. It produces air pockets and spikes. Understanding this keeps you disciplined. Noise increases near inflection points. Those who confuse noise with signal exit early. Those who recognize it for what it is stay positioned. The market isn't becoming riskier, it's becoming tighter. As price advances, psychology becomes the final battlefield. Yesterday, fear dominated. Today, relief took its place. But the most dangerous emotion in markets isn't fear, it's comfort. Comfort makes investors stop paying attention to risk, while volatility quietly increases beneath the surface. And silver is entering a phase where emotional discipline matters more than precision. This is where position sizing becomes strategy. If yesterday's move kept you awake, your exposure is too large. Not because the thesis is wrong, but because volatility is the toll required to stay in the trade. The path higher will not be smooth. $10 swings will become normal. Headlines will grow louder. Narratives will turn hostile again. This is not a flaw, it's confirmation. Strong trends shake participants repeatedly. They don't reward those who react, they reward those who endure. The goal is not to predict every swing, but to survive them without being forced out. That means anchoring your focus to what doesn't change. Your ounce count doesn't change, price does. As silver rises, attention will follow. Media coverage will increase, political scrutiny will intensify, calls for regulation, taxation, or intervention will grow. These are late cycle symptoms, not early warnings. They arrive after the move is already underway. This is why patience remains the edge. The accumulation phase feels boring. The repricing phase feels violent. We are transitioning between the two, and that transition is uncomfortable by design. Those who can stay detached from the day-to-day noise, who understand why volatility expands as trends mature, will be positioned to benefit from what comes next. Because what comes next isn't subtle at all. Now we step back and draw the final line because every market cycle leaves behind a lesson, and this one is unmistakable. What you witnessed was not chaos. It was conditioning. The market tested resolve before rewarding patience. It exposed leverage, punished emotion, and confirmed something far more important than a price target. The trend is intact, and conviction has value. The strategy from here is not complexity, it is discipline. You do not need to outsmart every fluctuation. You need to survive them. As silver moves higher, Volatility will increase, not decrease. That is the price of repricing an asset that has been suppressed for years. Sharp drops will occur. Violent rallies will follow. Neither invalidates the thesis. The lesson is simple. Focus on structure, not noise. Fundamentals are tightening. Supply is constrained. Demand is expanding. Monetary pressure hasn't eased, it has accelerated. These forces don't resolve quietly, they resolve decisively. For those who held physical through the fear, this was a proving ground. For those who panicked, it was tuition. Markets don't apologize, they educate, and the tuition just got steeper. As we move ahead, your edge is clarity. Know why you stack, know your risk tolerance. Adjust your ounces if needed, but do not abandon logic for emotion. The goal isn't to time the exact top. It is to ride the monetary